bootstrapping. Bootstrapping means you're doing everything yourself. $0 raised and 0% equity given out. Founders use personal savings, freelance cash, or ramen diets to get things started. Bootstrapping startups is insanely hard as you make no money at the start and you may even have to be juggling your day job at the same time. But if you manage to bootstrap your startup to success, it'll be insanely lucrative as you own 100% of the company and can decide everything yourself, friends, fools, and family. The FFF round, or Friends, Fools, and Family round, is usually raised for an idea stage venture before you have much to show for beyond a concept and some determination. These rounds are usually small in amounts, between 0 to 50k, usually closer to 0 than the 50k, and they're raised from people who you know and trust personally, sometimes more on trust than due diligence, in order to handle the starting costs at the very beginning of your company. Pre-seed. The pre-seed round is where you've already got a solid idea, a pitch deck, and maybe some basic prototype with early traction. Investors at this stage, often angel investors or early stage venture capital companies, are betting mostly on your team and vision. These rounds typically range from 50k to 500k, but there's huge variability by industry and region. It's enough to refund your product, prove your concept, and get it ready for the seed stage where you scale even more. Angel investment. Angel investments are made by wealthy individuals betting on you early. Angel investors are usually successful entrepreneurs who've exited their company, or then they come from wealthy backgrounds. Angel investment ticket sizes usually vary from 10 to 100k depending on the person in question. It's not exactly a funding round. Angel investors are usually involved in FFF rounds, pre-seed rounds, as well as seed stage rounds, which we're going to be talking about next. Seed round. This is for startups who are already in business, hopefully with solid traction and revenue. With the seed round, you usually scale the business from a small startup into a scale-up. The typical sizes are up to 2 million, and larger seed rounds can range up to 10 million. Now, there are some exceptions to this. So, for example, recently we've seen a lot of AI companies raise huge funding rounds with no profit at all or traction at all. So this could vary case by case, but these are just the rough averages we're talking about here. Series A to Z. Series A, B, C, and so on are for startups that have proven their business model and are now scaling aggressively, often into new markets or product lines. These rounds get progressively larger, but there's a huge variability in them depending on the industry, geography, and the startup's traction. A SaaS company in Silicon Valley might raise a $20 million Series A, while a biotech firm could raise a $50 million right out the gate. Typical ballpark ranges: Series A usually sized 2 million to 15 million plus, Series B 15 million to 50 million plus, Series C from 50 million to 200 million plus. After that, the alphabet just keeps going. Each letter usually means a bigger check, higher valuation, and more pressure to deliver. IPO. An IPO, or an initial public offering, is when a company lists on a public stock exchange and sells shares to retail investors and institutional investors. These deals can range from under 100 million on smaller exchanges to multi-billion-dollar Wall Street debuts. Founder payouts vary wildly depending on how much equity they've retained through earlier funding rounds. In big IPOs, this can mean tens to hundreds of millions, but heavy dilution can make the number far smaller than expected. Going public is a very big step and a win for the founders, but it's also a start of a new, more demanding chapter. You're now under stricter regulations with quarterly earnings pressure, detailed financial disclosures, and a crowd of new shareholders and analysts tracking every move you make. Exit and acquisition. An exit or an acquisition happens when another company, often a bigger player in the market, a private equity firm, or a competitor buys your startup. This can be for your product, technology, user base, or even just your team. Deal sizes range from small, quiet acqui-hires into the low millions to multi-billion-dollar takeovers. Founder payout depends on the purchase price and how much equity they still own. But in successful exits, it's often a life-changing sum. For many entrepreneurs, this is a checkered flag, the official end of the race. The company becomes a part of a larger organization. You finally cash in the years of hard work. Some founders stay for the transition, others hand over the keys and head straight for their next venture or their well-earned beach vacation. From bootstrapping to raising millions or crossing the checkered flag by exiting your startup, every funding round plays a huge role in a startup's journey. Each step comes with its own challenges and trade-offs and opportunities, and no two paths look alike. Which stage are you aiming for right now? Drop it in the comments, and if this helped you make sense of startup funding rounds, hit the like and subscribe button and stick around for the next guides on building and growing your startup.